The second thing is the economy is definitely weakened, and specifically the labor market is starting to weaken. You're getting a lot of layoff announcements across all sectors, not just technology, but you're getting a lot of layoff announcements everywhere. And on top of that, the massive rise in rates that we've seen year to date in 2022 has led to much higher debt payment cost for consumers. And a recent study by Bloomberg came out and showed that because of these significantly larger debt payments that we're all making now, the excess savings that consumers saved up from the pandemic is now pretty much all wiped out. So labor market is weakening while excess savings have been destroyed.
What's up, HGI investors, and welcome back to Hypergrowth Investing. I'm Aaron Davis, and as always, pleased to be joined by investment analyst Luke Lango. Luke, how we doing this week?
Doing good, Aaron. Doing good. The stock market is definitely starting to turn a corner. There are some fundamental and technical signals that are pretty constructive. There's definitely a question of leadership, who's leading right now. There's some pretty big divergences out there, but broadly speaking, equities look great right now. And I think now is a pretty good time to get pretty aggressive. So I'm feeling pretty good going into Thanksgiving.
All right. Well, looking forward to talking about who some of those leaders may be in just a few moments. If this is your first time joining us, Hypergrowth Investing is the weekly podcast that picks the brain of investment analyst Luke Lango. Each week, we take an in-depth look at emerging tech and investment innovations, automation, vertical farming, inflation, the housing market, and more. Nothing is off limits. If you're joining us for the first time, we go up every Wednesday on YouTube, Spotify, Apple, Google, wherever you choose to listen to your favorite podcast. So make sure to hit like and subscribe to get Hypergrowth Investing as soon as it goes up. Again, I'm Aaron Davis, educator, lifelong learner, and your proxy into the mind that is the Luke Lango. All right, Luke, you've been calling this nasty bear market of 2022 to come to an end for a few weeks now. And indeed, ever since early October, stocks have been powering higher. Is this the end of this bear market? And have we actually finally reached the other side?
Right, Aaron. Yeah, the market has definitely taken a material leg higher since early October. It's about 2 months now. And I do think this is a real rally and not a head fake like the March rally or the June rally. I think what's going on here is, there's a few things. Inflation is definitely rolling over. You got that really soft CPI print last month. You'll get another soft one in 2 weeks or 3 weeks. You'll get a soft PCE at the end of this, or the beginning of next month, December 1st. So I think inflation is definitely rolling over. Today, the Richmond Fed manufacturing index came out, and it was a miss, but the bigger point there was that the prices paid index fell to its lowest level in several months. So inflation is definitely rolling over. Oil prices are coming down. You're definitely seeing home prices come down, rents come down. So you're seeing inflation roll over. The second thing is the economy is definitely weakened, and specifically the labor market is starting to weaken. You're getting a lot of layoff announcements across all sectors, not just technology, but you're getting a lot of layoff announcements everywhere. And on top of that, this massive rise in rates that we've seen year to date in 2022 has led to much higher debt payment cost for consumers. And a recent study by Bloomberg came out and showed that because of these significantly larger debt payments that we're all making now, the excess savings that consumers saved up from the pandemic is now pretty much all wiped out. So labor market is weakening while excess savings have been destroyed. That leads to a situation in 2023 where the consumer is really significantly weaker than they are today, and you get serious demand destruction, which should lead to more disinflation. So with all of these forces building, this disinflationary wave building, you are now starting to see Federal Reserve members talk a little bit more dovish than they have in the past, where a few of them have come out and said, okay, we're worried about maybe overhiking. We don't think we need to go too much farther. Maybe we should let our higher rates just marinate for a bit as opposed to continuing to hike. So all of these stars are starting to line from a macroeconomic backdrop for 2023 to be a year of rapidly falling inflation and the Fed becoming increasingly less aggressive. That's why stocks are starting to turn a corner here in late 2022. They see the inflection point, they see the light at the end of the tunnel, and they're racing towards it. Investors are racing towards it. Stocks love to discount things before they happen. They look 12 months into the future. 12 months into the future, inflation is going to be much lower than where it is today. Interest rates will likely be lower than where they are today. Treasury yields will likely be lower than where they are today. And the economic outlook will likely be much better than where it is today. So it makes sense that if all those things are true 12 months out, stocks are rallying today, turning a corner today. Technically speaking, the Dow kind of had this very well-defined downtrend channel year-to-date 2022. It's broken above that now for the first time ever. The S&P 500 is making a run at its 200-day moving average, and the Nasdaq is lagging significantly. But if those other two indices really start to push higher, the Nasdaq will as well. So I think there's a lot of fundamental and technical factors working in favor of the stock market here in late 2022. You also have seasonality playing a big tailwind, and you also have politics playing a big tailwind. Remember, stocks have never dropped in the 12 months after a midterm election. So we are starting that period, the 12 months after a midterm election. Stocks normally rally during these 12 months, always rally in these 12 months. So you have the political tailwinds, the seasonal tailwinds, fundamental tailwinds, technical tailwinds. Things are starting to look pretty good for the stock market over the next 12 months. I continue to believe we're going to get a year-end rally, and we're going to start coming to a new bull market in 2023. And perhaps the most interesting data point, if there's like one data point I really want to emphasize here about that, is what we've seen in 2022 is really rare. We've had a greater than 24% drop in the S&P 500. This is in mid-October. We had dropped more than 25% on the S&P 500 to a P multiple of less than 18 times. So not only do we have this steep sell-off, but we had a steep sell-off to relatively discounted territory. That's important combining the two, because a lot of times people are comparing the current market to the 2000, 2001, 2002 dot-com crash. But the parallels don't hold water because the valuations don't match up. The S&P 500 never dropped below 18 times earnings during that entire crash. It bottomed at valuations higher than 18 times earnings. So that parallel doesn't really hold water because the valuations don't match at all. So if we look at the two factors here, S&P 500 down more than 24% and trading at less than 18 times trailing earnings. That's an incredibly rare combination. We ran the data on this, the numbers on this yesterday. What we came up with was that in the past 70 years, since 1952, that trading action has occurred 103 weeks. So just 2.9% of all weeks. So just 2.9% of the time in the past 70 years has the S&P 500 traded down more than 24% and traded at a P multiple of less than 18 times. That's where we were in mid-October with the S&P. Only 3% of times in the past 70 years. 99% of those times, stocks were higher a year later. 99% of the time. And only 1 week in the past 70 years did stocks fall to where they fell in mid-October, down 24% or more, to a P multiple of 18 times or less. And only 1 week did stocks fall to that situation and not rally over the next 12 months. And that was early October 2008, right after the Lehman Brothers bankruptcy. And stocks dropped, the S&P 500 dropped 6.7% over the next year. But guess what? By December, so 14 months out, stocks were higher. In other words, in October, we dropped far enough to a depressed enough level that historically speaking, whenever stocks do that, they have a 99% chance of rallying over the next 12 months and a 100% chance of rallying over the next 14 to 15 months. And not just that, but the average returns in those 12 months are enormous. The average return is 26.4%. So that is truly a mind-boggling statistic to me. It says that either this time is truly different, meaning we're about to do something we've never done in 70 years, or stocks are going to soar by more than 25% over the next year. When you put it that way, it seems almost like a rhetorical question. It's like, do you think this is going to be the first time something happens in 70 years, or is history going to repeat the exact same way it's repeated every 10 or so years for the past 70 years? Probably the latter, right? Like there's a significant probability of the latter. So what history is saying is there's a 99% chance we rally big over the next 12 months and a 1% chance we don't. I'll take my odds on that. I'll take my odds with the 70 years of history saying we're about to soar. Now, if we go deeper in that analysis, we actually, because we're tech investors, we like to focus in on technology stocks. We ran that specific analysis on the S&P 500 tech sector. So where the S&P 500 tech sector was as of mid-October was the S&P 500 tech sector was down more than 30% and trading at less than 24 times trailing earnings. So down more than 30%, trading at less than 24 times trailing earnings. That is incredibly rare. It has only happened in 36 weeks in history. That's 2% of all weeks. 100% of the time, with zero exceptions, tech stocks were higher a year later. And the average return in the S&P 500 tech sector when those conditions were present over the next year was 50.2%. 50%. So we have these two things right now. S&P 500 dropped to levels that historically speaking, when it drops those levels, it rallies 99% of the time over the next year by about 25%. Zoom in on the tech sector. The tech sector dropped to levels in mid-October that historically speaking, 100% of the time it has rallied from over the next 12 months with an average return over those 12 months of 50%. I don't know how you argue with those stats. I don't know how you argue with those numbers. The only way you do is if you have a really compelling argument that this time is different. This is a unique situation we've never seen before in 70 years that's going to cause the first negative outcome from those conditions.
So then let me ask you this, devil's advocate. And again, you paint a great picture of all the indicators of why we are in this turnaround right now. Are there any indicators that show that this is just a short-term rally, that we're not quite out of this bear market yet?
I mean, I think there are definitely a lot of indicators that say, yeah, we could take, another leg lower, that this could drag on for a little bit longer. But I'm not seeing any indicators that say we're going to be lower 12 months out. And so that's the way I'm looking at this. Like, I'm not looking at the market from the perspective of, we might yo-yo. It might run up the 200-day, get rejected, come back down, make a new low, then run right back up at the 200-day. We probably
12 months out.
We could do all these things. I think over the next 6 months, we could do a lot of yo-yoing, a lot of, up and down, zigzag, whatever. But I am very confident that 12 months from today, and 12 months from where we were in October, 12 months out from those levels, October 2022 to October 2023, November 2022 to November 2023, stock prices will be higher. And not just slightly higher, but meaningfully higher, 10%, 15%, 20%, 25% higher. So that's the way I'm looking at it. I'm not here saying, okay, we could nosedive all the way down to 3,000 and then reverse course and rally. But if we do, that rally is going to be very powerful. What I'm saying is that regardless of which way the roller coaster goes over the next 12 months, the destination is going to be at least 10, 15, 20% higher than where we are today. So from that perspective, I think a new bull market has begun. Yes, there are some indicators saying we could take a leg lower before we take that face melting rally higher, but I'm not really concerned about that. I'm invest for at least 12 months or longer. And on that horizon, stock prices are going to be higher 12 months out and significantly higher, 15, 18, 24 months out. So that's the way I'm looking at things. And again, to me, it's really all fundamentally driven. 2022 was a year defined by rising inflation, an increasingly aggressive Fed, rising interest rates, soaring bond yields, and declining economic activity. 2023 will be a year of falling inflation, an increasingly dovish Fed, falling interest rates, falling treasury yield, and restabilizing/improving economic activity. So we're doing a 180-degree turn here on all the inputs. That means the output should do a 180-degree turn as well. And so from that perspective, stocks got crushed in 2022. I think they rally and take it all back in 2023.
Okay, so coinciding with what I've been kind of reading in your daily notes recently with you saying that stocks are going to power higher into 2023, you seem to be focused in who's going to be leading this new market.
Right.
You're still hesitant about what stocks are going to be the leaders in this new bull market. So the question I guess I have is who's this going to be? Is it going to be tech, growth, value, oil? What stocks are going to be the best in this new bull market in 2023 and beyond?
Right. Yeah. So leadership is a very important question right now. And there are two schools of thought. One school of thought is that we're entering a new investment regime. So what worked in the 2010s is not going to work in the 2020s bull market. The other school of thought is that we are not entering a new investment regime. And so buy the dip in what worked in the 2010s because it's going to work really well in the 2020s. Right now, the market seems to be taking at least a short-term stance that it is a new investment regime. Because if you look at the performance of the indices since late September, early October, the Dow Jones, which is full of a bunch of old school value-oriented companies, that index is up 16%. The Nasdaq, tech heavy, growth heavy, is up just 2%. That's a massive 8-to-1 performance delta. You don't see that. You never saw that in the 2010s. When markets rallied, the NASDAQ led, always, because tech and growth led, always. And indeed, in 2022, whenever we had those counter trend bear market rallies, like the one in March, like the one in June and July, those rallies were led by growth and tech. The NASDAQ gained more than the Dow in those counter trend rallies. But here we are in the October-November rally, and the Dow is significantly outpacing the NASDAQ, up 16% to up 2%. That's wild, and you have to make note of it. You can't reject that price action. So why is it happening? Well, I think the reason it's happening, what kickstarted that outperformance? The Bank of England pivoted towards quantitative easing in late September. They were doing quantitative tightening, they were hiking interest rates, and then they capitulated, threw in the towel to financial market chaos and started buying bonds. They kickstarted QE. And that is what started this massive October-November rally and what started this massive performance delta between the Dow and the NASDAQ, between value and growth, between cyclical and tech. What I think the market is interpreting from that is that the Fed is going to follow the Bank of England, and the Fed is going to pivot soon enough to save the economy, but too soon to kill inflation fully. So they're going to pivot. I think the market is saying they're going to pivot sometime in early 2023. And at that point, that pivot is going to be early enough to save the economy. So growth is going to be good in 2023. But inflation will probably be like 4% at that time. And therefore, and it's probably not going to head much lower. So then 2023 is going to be a year of decent growth, but still moderately high inflation, which means moderately high interest rates and moderately high yields. So in that environment, Dow stocks outperform NASDAQ stocks, value outperforms growth, cyclicals outperform tech. That is the stance the market has been taking over the past 2 months. That's very clear in the price action. They're saying the Fed's going to pivot soon enough to avoid a recession, save the economy, but they're going to pivot too soon that they won't be able to kill inflation, and therefore inflation is going to remain higher in 2023. It's going to remain, yields are going to remain higher, rates are going to remain higher in 2023. That's the outlook that the market is taking. And I definitely see that outcome and see that scenario and see why the market is believing that. But my stance is that that gives far too much credit to the Fed for an early pivot. I don't think this Fed, especially based on comments from Powell, is going to capitulate until inflation is almost for certain heading back to 2%. They've made that very clear. Price stability is more important than avoiding a long-term price stability is more important than avoiding a near-term economic recession. So I do think the Fed pivots in 23. I think they become increasingly dovish in 2023, but I don't think they pivot too soon to not kill inflation. I think they pivot at a point where they will, in fact, put the nail in the coffin of inflation. So who's going to lead in 2023? Well, if we look at it from that perspective, my outlook is the Fed does pivot in 2023, but not as soon as the market is anticipating. And instead, we'll pivot at a point that will allow the economy to avoid a recession, yes, but it will be a growth slowdown. Yet it will pivot at the point at which inflation will actually die. So I think that inflation does go back to 2% in 23, yields collapse, and rates get cut. And I think from that perspective, what works in 2023 is going to be tech stocks. I think tech stocks are going to work best. I think that's going to be the leadership group of 2023. What's going to work 2023 plus? I think it's tech stocks as well. A lot of people misunderstand the deflationary force of technology. A lot of people misunderstand the globalization trend. People are saying globalization is becoming localization. That's not true. Globalization is becoming selective globalization. Apple was in China. Now they're going to India. They're not coming back to America. They're going to India. Yes, Taiwan Semi is building a plant in Arizona, but guess what? That plant is going to have so much automation. And the only reason they're doing it is because they're going to be able to produce those chips at cost comparable to, if not lower than what they're doing in Taiwan. Everything comes down to cost, and people are going to make the most cost-effective decision. So I think that we are still in a secular deflationary environment. We are in a secular environment wherein rates will remain low, inflation will remain low, yields will remain low, and that's an environment in which tech stocks, I think, outperform. So I think that in the interim, leadership will probably be the Dow, cyclicals, commodities. But by early 23, mid 23, that leadership is going to shift, and it's going to shift for several years towards a tech leadership angle. And so that's where I think stocks will do the best over the next few years. And that goes back to the point of the data that we pulled up of, okay, the Nasdaq is down more than 30%, trading at less than 24 times forward earnings. Whenever that is the case, historically speaking, 100% of the time, tech stocks are higher a year later, and they're up by, on average, 50%. So specifically that happened, that scenario, down 30%, less than 24 times earnings on the tech sector. That happened in late 2008 and early 2009. That happened in March 2020, and it happened in late 1990. So these occurrences span over 3 decades. It's not just like there was just one investment regime for 3 decades. And in the early 1990s, it was a different investment regime than in late 2000, early 2009, different investment regime than March 2020 during the COVID pandemic. Yet during all those periods, through all those different investment regimes, when tech stocks did get to this depressed of a point, down 30%, less than 24 times earnings, they soared over the next year by about 50%. So I think history repeats here. This is not going to be the first time tech stocks don't soar from these conditions. So I think 2023 is going to be a record year, a very strong year for technology stocks. That's where I think the leadership will eventually morph to.
Okay, so you're definitely betting big on a tech resurgence in 2023, but tech as a whole is huge. I think the question that I have right now is, where specifically are you looking for in the tech world? And you know what, let me just make it a little easier for us. Let me just throw out a few different sectors and just kind of give me your take on them as we move forward. So First off, right now, sports betting. World Cup is on, NFL is underway, NBA is underway, college hoops, football is underway. Stocks like DraftKings, what do they look like in 2023?
Sports betting is an interesting sector. I think there are some legal tailwinds there, and I think the industry as a whole is going to grow. I think revenues in the sector are going to grow. I think it's becoming very, very popular. That's just, you can see in casino stocks. Casino stocks have been doing very, very well. Gambling, betting, stuff of that nature tends to do well when the economy gets rough because it's kind of a vice of sorts. And it's a way for people to potentially make money, make back what they lost in stocks or make back what they lost in their job or whatever it may be. So gambling and stuff like that is a vice that tends to do very well in an environment that we appear to be going into in 2023. And I think sports betting is especially online sports betting is the hyper-growth niche of that vice and has a lot of strong legal tailwinds. So I think the whole industry will do very well from a revenue intake perspective, from a betting volume perspective in 2023. But I don't think that portends very well to the stocks. I think a stock like DraftKings or a stock like GAN or, one of these kind of sports betting technology stocks or even just sports betting pure play stocks. The problem for me is that there's no real competitive moats being built here. And therefore, the only way these companies are growing in this hyper growth industry is to spend and spend and spend and spend and spend and spend and spend. So while revenues at a lot of these companies are heading higher, profit margins are getting eroded and losses are piling up, or net profits are falling, or net profits are turning into net losses. So you're not seeing massive revenue growth in the sports betting industry turn into massive profit growth for sports betting companies. And until one of these companies develops a real technological advantage, marketing advantage, some big competitive advantage that will enable it to grow margins alongside revenues, to not have to spend an arm and a leg to grow, until that company comes along or that breakthrough happens, I think sports betting stocks will not do very well, even if the sports betting industry does grow rapidly. So a name like DraftKings, I'm not terribly bullish on that stock here and now.
Okay, there's sports betting. Next sector, electric vehicles. Tesla, Lucid, Rivian, Canoo, QuantumScape, et cetera. They're all crashing right now. Are they going to rebound in 2023 or are they going to keep falling?
So I think electric vehicle stocks mostly will rebound in 2023, except for Tesla. And I think the story here is that electric vehicles have massive legal tailwinds. You got the huge Inflation Reduction Act that just got passed, $400 billion going to clean energy stuff. A lot of that was extending EV tax credits, introducing EV tax credit for used vehicles, infrastructure for EV charging. So I think there's a lot of legal tailwinds here in America. There's a lot of legal tailwinds over in Europe. They're really pushing for electric vehicles. And China is really doubling down on electric vehicles. So I think the legal tailwinds are very powerful. And they're going to grow more powerful in 2023. China is going to eventually come back online. I know the COVID lockdowns have gone, it's like a total disarray right now, but eventually they're going to come back online. And I think they do come back online in 2023. So I think the supply chains over there, battery manufacturing, lithium mining, stuff like that is going to really boom in 2023. That's going to help the electric vehicle supply chains, help the production rates of EV makers like Tesla, Lucid, and Rivian. So I think that's a positive going for these stocks. I think the third positive is that I think demand is just still very, very, very strong. Demand's never been a question. I think demand is going to continue to accelerate. It's becoming sort of there's a network effect here. Your neighbor gets an electric car. The guy across the street gets an electric car. Okay, maybe I'll get an electric car. You get an electric car. Okay, your friend gets an electric car. Like, it's sort of a domino effect taking place. And I think what was that? FOMO. Yeah, FOMO. And I think that a lot of these, the dominoes started to fall pretty rapidly in 2022, and they're going to fall more rapidly in 2023 because there's a lot more optionality in the market, a lot more different types of electric vehicles you can choose from in 2023 than in 2022, then in 2021, then in 2020. So as optionality increases, demand gets to accelerate. I think it's a pretty cool situation for the electric vehicle demand picture. So I think a lot of those things are working in their favor. And then I also believe that lithium prices, copper prices, magnesium prices, cobalt prices are going to moderate in 2023 as well, as disinflation wave kind of wipes across the whole globe. So you have to remember, those commodity prices are based on global economic factors, not U.S. economic factors alone. And while the U.S. economy looks likely to stave off a recession and be all right and have pretty good economic demand in 2023, the rest of the economy is not. The rest of the global economy is not that situation. South America is really struggling. Europe's really struggling. And all of Asia is really struggling as well. So I think that global economic demand is going to weaken in 2023, which is going to allow global metal prices, industrial metal prices, to come down. So all of these things are going to work in favor of these companies in 2023. But I think Tesla is going to lose because of market share erosion. That the company's market share, global EV market share, peaked at like 18, 19% a few years back. It's been steadily coming down ever since. As of last month, trailing 12 months, it was about 13.8, 13.7%. So their market share has been coming down, and I think that's going to continue to come down. Rivian's really ramping production. Lucid's ramping production. Fisker just started the Ocean production. GM is going all in. Ford is going all in. Volkswagen is going all in. That the number of electric vehicles Tesla is going to be competing against in 2023 is going to be exponentially larger than the number of electric vehicles it was competing with competing against in 2022. At the same time, I think Tesla brand equity is collapsing. I think it's not becoming a cool car anymore. It's so common. It's basically commoditized. So I don't think there's anything there. And there's really no innovation in the pipeline. With they get the Model 3, the Model X, the Model S, the Model Y. Like, we already know that lineup. Give me something new. Give me something sexier, cooler, cheaper. They're not giving consumers any of that. So I think the product lineup's growing stale. I think market share erosion is a big problem. Competition is getting stiff. So I think EV stocks generally do very well in 2023, but I don't think Tesla stock leads that rally. I think it lags it and may even struggle throughout the year, even if the market soars. So not bullish on Tesla, but very bullish on a lot of the other EV stocks. And I think very, very bullish on a company like Rivian. Rivian, to me, has displayed operational excellence over the past few months. They had the recall, but they addressed that recall in the most transparent, forward manner you could ask anybody. Recalls are common in this industry. They happen. Tesla has so many recalls, but most recalls are forced by the government. The company themselves doesn't come forward and is not transparent about it. Rivian was not forced by anybody. Rivian said, we identified the problem in very few cars, but you know what? It's a problem. We're going to fix it for free for everybody. Here it is. We're going to let everybody know. They took it on the chin. They owned it. There was accountability there. And now they're back, running on all fours and ready to go with the production. So I really like what Rivian's doing. I love the brand. I'm seeing the cars. Everybody I talked to that owns one loves the Rivian. So I really like Rivian in 2023, but I think EV stocks in general can do very well next year.
All right. Moving on. Enterprise software. Names like Salesforce, Allison, Palantir, some of the best performing stocks of the past decade. They've also fallen hard, are big in rebound in 2023.
I think enterprise software stocks are going to be really strong in 2023. Gartner just came out with its annual research report on IT spending trends for the year ahead. And IT spending barely grew in 2022, but IT spending is about 0.8%, I think was a number. But IT spending is expected to grow more than 5% next year. So we're going to go from a year where IT spending, enterprise software spending barely grew in 2022 to a year in 2023 where enterprise software spending, IT spending is going to grow by a lot. Now, the reason for that is because companies are actually leaning into enterprise software technologies in moments of economic turbulence to shore up their operations, to save money, to improve efficiency. These are seen as tools to help companies navigate turbulent times, as opposed to tools we're going to cut back on during turbulent times. They're tools people are going to pick up spending on during turbulent times. So, and a lot of these software stocks have been crushed. The cloud computing ETF is trading at one of its lowest valuations ever. So I think a lot of these cloud software stocks are priced for demand destruction in 2022. What they're going to get is demand reaccelerate in 2023. And what they're going to get is demand reacceleration in 2023. That demand reacceleration will converge on really depressed valuations in software stocks. Then you're going to get a big, big, big boost in those stocks. Not to mention the reason software stocks have always been so expensive and even today are still pretty expensive even after the wipeout is because they're the best business models in town. I mean, these companies operate at 80, 90% gross margins with 40, 50% EBITDA and operating margins with very low capital intensity and free cash flow conversion rates of 80 to 90%. So these are companies that turn revenue into cash flows. Like, that's what they do better than any other business on the planet. So the fact that they trade at premium valuations, there's a reason for that, and you need to buy them on the dip as soon as demand reaccelerates. And so I think that's what we're seeing right now. And I would be a buyer of enterprise software stocks. A lot of our buying recently has been concentrated in the enterprise software sector.
Okay. Another tech sector, e-commerce. You've said the growth rates are turning around there. Shopify, Chewy, Etsy, are they ready to make a comeback too?
Yeah, I think that as well. I think so. E-commerce, you talk about one of the pandemic seesaws, right? E-commerce boomed during the pandemic in 2020. And then in 2021, as the quarantine restrictions and all that stuff faded and social anxiety faded, growth rates decelerated. And in 2022, they've continued to decelerate, especially as the economy's gotten into a rough patch. So that was one of those things that grew like wildfire. And then now is for about 2 years has been consistently decelerating growth. But over the past 2 quarters, we've seen growth across the e-commerce sector. When you look at the U.S. Census Bureau's U.S. e-commerce growth rates year over year, they started to plateau and turn around. And in the third quarter of 2022, they really started to turn around. And I think that is, one, a sign that we've went through this whole rapid growth offset by deceleration, and now we're back to a more steady state, normalized growth trajectory, which before the pandemic was growing 10% year over year. We're getting back to that. So I think we kind of did the seesaw and now we're back to normal growth. So I think 2023 will be a year of renewed growth for the sector, re-accelerating growth for the sector. And then two, I think a lot of people are kind of like, okay, I was sick of shopping online during the pandemic, so I went out and shopped in stores and all that stuff throughout 2022. But now gas prices are really high, and now my stocks are down a lot. And now a lot of people are getting fired, and everybody's talking about a recession. So maybe I'll save the money on going to the store, and because I already did it, like it was fun. Maybe I'll just shop online again. Maybe Amazon's cheap, right? It's it's free delivery. Like might as well just do that. Save the gas. Sounds good to me. So I think that's the logical framework a lot of consumers are working through right now. And that is sparking some of this reacceleration that we're seeing right now, which I expect to persist into 2023. So I think a lot of those e-commerce stocks, like you mentioned, Shopify, Etsy, Chewy, Amazon even, I think a lot of those names are ready to break out in 2023. I really like Shopify. I think there's a lot of power in that business right at these levels.
All right. Next sector I have for you, fintech. I know SoFi is a darling for you. What's the outlook for fintech like SoFi and Square going into 2023?
Right. So I think lower interest rates, lower inflation, and a stronger outlook for consumer spending going into 2024 will help those stocks dramatically next year. Higher interest rates have really hurt them this year, and have hurt their valuations this year, and so has the deteriorating economic outlook for consumer spending. But again, I think those things do a 180-degree turn starting now into the next 12 months, and that is going to cause the stocks like Square, like SoFi, like Affirm, all that stuff, to do a 180-degree turn as well. But I think what has been a crashing course for those stocks will become a soaring course in 2022 or 2023. And I really do like SoFi. I think SoFi stock is, at $5 is an absolute steal. We've been over the bull thesis many times. We don't need to go over it again. But I really like SoFi stock in 2023, but it's not the only fintech. I think a lot of the fintechs can rally.
Okay. Last sector I have for you, clean tech, solar, wind, hydrogen, etc. Bullish for 2023?
Yeah, it's been one of my favorites for a long time. You know that. And I believe that it's going to continue to sustain strength in 2023. Again, the legal tailwinds here are enormous. Standalone energy storage has its first investment tax credit in the United States ever. Green hydrogen production has its first production tax credit in the United States ever. You're getting billions and billions and billions going into EV charging, going into solar panels. There's so much legal political money going into these. And then in Europe too, Europe has made it very clear that we need energy independence, and we're not going to seek it through natural gas and oil. Like a lot of people thought, okay, they're going to scream uncle and go back to natural gas and oil. But that's not what they've done. They've actually, if anything, enacted more aggressive policies for the clean energy revolution, for solar, for hydrogen, for energy storage, and all that stuff. And the amount of projects being announced every single day over there is enormous. So I think you have massive tailwinds in the clean tech sector. And I really like solar, energy storage, and hydrogen. That's kind of the triumvirate of clean tech. And of that triumvirate, I think the real winner is going to be energy storage. The fact of the matter is that none of this whole energy transition works unless you have storage, because clean power is intermittent, unless it's hydrogen, which is why I like hydrogen, because it's not intermittent. But even hydrogen, it's produced through solar, green hydrogen. It's produced through wind. It's produced through that stuff. So it still has an intermittent component to it. Regardless, battery energy storage systems are the absolute necessary focal point of the energy transition. We need them in order to enact the energy transition at scale and make it a ubiquity. So I really like battery energy storage stocks going into 2023, but I also like the whole clean tech space. Solar stocks have been really strong recently. Q3 earnings for solar companies were fabulous. All those companies double beat and raises, accelerating growth, bullish outlooks, bullish management commentary, expanding margins. solar companies are on fire right now, and I think that persists. Solar stocks are also on fire too, and I think that will persist in 2023.
All right. We've definitely gone over where you're bullish. Are there sectors you're bearish for in 2023? And if so, are these sectors something that we should stay away from altogether or simply just in the near 2023 outlook?
Right. Yeah. What am I bearish on in 2023? Well, I think a lot of the things I'm bearish on are actually the things that worked in 2022. Because again, I see this investment landscape, macroeconomic landscape shift from 2022's rising inflation, rising rates, rising yield environment to 23's falling inflation, falling yields, falling rate environment. So I believe that, I mean, this makes sense that if you change the input, the macroeconomic model, you change its inputs 180 degrees, then the output should change 180 degrees too, right? I mean, that just makes sense. So energy stocks have worked very well in 2022, and absolutely congratulations to people that have played that. And in 2021 as well, they worked really well in 2021. But energy stocks don't tend to be multi-year winners. They tend to be two and out. They have 2 great years and then they're out. And I think, we're coming up on year 2 of great performance, and I think year 3 is going to be out. I don't think energy stocks are going to sustain their outperformance throughout 2023. I think they could have a good first quarter or maybe something like that, but I don't think they sustain their performance throughout 2023. I think we're at peak earnings for energy. If you look at the S&P 500 energy sectors projected earnings over the next 2 to 3 years, this is the peak, and earnings are expected to decline next year and in 2024. Historically speaking, you pull up the graph of the S&P 500 energy sector next to its earnings. Since 1990, it tracks earnings. When earnings rise, the sector rises. When earnings fall, the sector falls, and the sector tends to peak when earnings peak. Well, we're at earnings peak today, or we'll be at earnings peak by the first quarter of 23. So I think that we're at or near the peak of the energy stock outperformance trend. So not very bullish on the energy sector, not very bullish on the defensive sector or the cyclical sector. I think that defensives have been overbid in 2022 because of fear of a recession that simply isn't going to materialize in 23. So once the recession doesn't materialize, I think, buyers of those stocks become sellers of those stocks as we get rid of protection and go risk on in the investment environment. So not very bullish on defensive names and consumer staples names for the full year 2023. But it's going to be hard to find losers next year, I think, because again, the data dropped 24%, less than 18 times earnings on the S&P. 99% of the time, that leads to a 25% plus rally over the next year. If the S&P 500 does rally more than 25% over the next 12 months, rising tides lift all boats. Very few stocks will be down over the next year. Very few. So, am I bearish on things? Yes. But even the things I'm bearish on, I think can work next year. They're just going to work less well than other things.
Okay. Well, that kind of rounds out all my questions. But we definitely still have a few fan questions. Starting off with Lori Vagrin. Open Door has a class action lawsuit. Should people still stay with your recommendation? Massive sell-offs from inside the company. What gives Luke?
Class action lawsuits have never. I've seen them dozens and dozens and dozens and dozens of times. If a stock drops, it's gonna have a class action lawsuit. And I don't make anything of them because 99.99999% of them result in absolutely nothing. They're just lawyers looking for investors that are pissed and get them to sign a lawsuit in hopes that they're going to have a 1 in a million chance of winning it. Those lawsuits never materialize in anything. So no, I'm not at all concerned about that or any other class action lawsuit against any other company whose stock price has declined. That's what happens. So on was it insider selling she's worried about or layoffs?
Massive sell-offs from inside the company. Inside selling.
Insider selling, yeah. There's been some insider selling at Open Door for a long time, but the selling is quite small relative to the positions these people own. I don't like that there's insider selling. That's definitely one thing I don't like about Open Door. But I take comfort in the fact that for me, this is a long-term play. I think they are going to get to the other side, and I do think that this is going to be a 5-10 year mega winner from current levels, like absolutely mega. So I'm not really too concerned about the insider selling. I mean, to me, it comes down to the fundamental belief. Does the real estate transaction process need to be digitized? And to me, the answer is absolutely yes. Why on earth are we paying middlemen such as brokers, such as real estate agents to take so much money? 3% on the buyer side, 3% on the seller side for what? Like, the industry is broken. It is so inefficient. It is a terrible industry. It needs to be digitized. It needs to be made efficient. It's going to happen. And I think Open Door has the resource and technological ability to do it. But at the end of the day, everybody keeps asking about Open Door, Open Door. Yes, the stock is getting crushed. It's been crushed. It's been absolutely crushed. I'm sorry for the recommendation. It's been crushed. Like that's just the fact of the matter. It has been crushed. The housing market went upside down. It's been a terrible time for all housing stocks, all iBuying stocks, all digital real estate stocks. It's just been a terrible time for all those stocks. But I didn't get in this stock because of a housing market boom or bust or this or that, or class action lawsuits, insider buying or selling. I got in the stock for one simple reason. The real estate industry is filled with far too many middlemen that need to be digitized out and that need to be automated out. And somebody is going to do that. And I believe that somebody is Open Door. That remains true. I get the stock might not work out, but my fundamental bull thesis for why I got in the stock remains the same as it was when I got in the stock. So I stay bullish on the stock. My fundamental belief is that you need to get into a stock for a reason. And you should only sell that stock when the reason you got into the stock changes, or you have reason to believe the reason you got into the stock is no longer true, no longer valid. I got into the stock because I think they're going to have great earnings. Oh, earnings were not great. The stock collapsed. Probably time to sell. You need to have a reason for getting into a stock. And once that reason changes, then and only then do you sell the stock. But a lot of people get into stocks for a reason and then sell it for a different reason. That doesn't make any sense. Because if your core reason is still true, then you still have that belief. You should still stick with the stock. And that's where I am with Open Door. It has been a massive loser, no doubt about it. But the reason I got into it is I think iBuying is the future of housing. And I think Open Door is the king of iBuying. So I think Open Door is the future of housing. Still believe that today, even though the stock price has been crushed. We'll see if that ends up being true, but I may be wrong, may be entirely wrong. And if so, it was a 100% loser. That happens in your career sometimes. But for right now, I think that remains true. And therefore, I stick by my bullish call on the stock. Absolutely.
Okay. Next question from Rusty Russ. Bullard is now saying they need to raise rates to much higher, between 5 to 7%. FFR ongoing. What do you say to Bullard's statement versus your expectation that they will pivot?
Bullard's been the oddball hawk for a long time. He's always been the most hawkish person on the Fed. And so the fact that he's saying all that stuff, it's just totally in character, right? It's totally in character. It's like the party animal that drank too much. He's going to drink too much the next time. That's Bullard. Bullard is the ultra hawk. And if he sounds super hawkish, makes total sense. No shock, no surprise. Notice how the market didn't really react. Had one bad day in response to those comments and then rallied the next. Market didn't really care what Bullard had to say. 2 reasons. Well, 3 reasons. 1, the reason I just gave you, because he's always the hawk, so expect him to sound hawkish. 2, everybody else is sounding more dovish. I got to actually pull up a list right here just for this question of all of the Fed speakers, Fed presidents that have sounded more dovish in response to Bullard's more hawkish comments. So San Francisco Fed president, Mary Daly, she said that rates are going to peak in the 4.75 to 5.25% range, which is what Bullard called the minimum. So she calls that the maximum. And she said they need to be aware of the lag effects and that they may be going too aggressively and they may need to slow down. Vice Chair Lael Brainerd, who's the second most important person on the committee besides Powell himself, said the central bank should moderate soon. And she didn't really say exactly that they need to stop rates, but she definitely said we need to be mindful that we may not need to raise rates as high as we thought. the Boston Fed president, Susan Collins, came out and said that they need to keep raising rates, but the risk of going too far have definitely increased. So that's definitely a dovish slant. And Atlanta Fed President Raphael Bostic came out and said they only need to go another 75 to 100 basis points higher for maximum rates. So, yes, Bullard is super hawkish. His colleagues are turning dovish at the time that he's going more hawkish. So that's why the market's not really buying Bullard's bluff. And then the third reason is that Bullard's off the committee next month. Bullard doesn't vote in 23. Bullard was a voting member this year, and he's not a voting member in 23. So who gives two flying Fs what he thinks? if he's not even on the voting committee, doesn't even decide what interest rates are in 2023, why does it matter what his opinion is important as mine right now, really? So at the end of the day, I think that you have to listen to the people that are actually going to vote next year, and you have to look at the consensus of those people. And the consensus of those people is, well, we still need to raise rates, but maybe not so aggressively. And maybe we need to be mindful that we could walk into a recession. Maybe we should pause. Like, those are the thoughts running through the consensus brains on the Fed voting members for 2023. And if those thoughts are running through their head right now, then, come early 2023, when inflation is much lower, when unemployment is higher, those thoughts turn into, okay, we need to maybe definitely think about pivoting or stopping right now. So the pivot has started. The psychological pivot has started. Remember, the pivot's a process. The pivot starts with the Fed members starting to sound a little bit more dovish. And then it turns into we hike rates less, which they're going to do in December. They're going to go from 75 to 50. And then it turns into, okay, maybe we should just stop hiking rates altogether. And then it becomes rate cuts. So this is a 4-part process. Part 1's already happening, right? We've heard Fed members sound more dovish. Part 2, less aggressive rate hikes. That's going to come in December, 75 to 50. Part 3, we're going to stop hiking rates. That's probably sometime in the first quarter of 23. Part 4, rate cuts. That probably happens mid to late 23. So we've started this 4-part, 12-month dovish pivoting process. And as a result, stocks are starting to turn around. And I believe they will continue to rally as this process gets underway and completes over the next 12 months. So that's where I stand on the Fed. Not to mention, I think one of the reasons I have real confidence in the Fed pivot is that the Fed does pay attention to yield curves, and the one they do pay attention to the most is the 10-year, 3-month spread. They look at the spread between the 10-year yield and the 3-month yield, and that spread has turned very negative, minus 50 basis points. Last time Powell was up there speaking, they asked him about that spread. Are you watching it? He's like, yes, we're watching it, but it's still positive, so I'm not too concerned. And it was at that point in time. It was like 13 basis points positive. So yeah, but now it's minus 50. So what are you going to do now? I mean, that's a huge swing. We're 63 points lower. Every time the 10-year, 3-month yield has been 10-year, 3-month curve has been this deeply inverted, the Fed's pivoted. So I think that the deep inversions on the yield curve are screaming Fed pivot on the horizon. Again, that doesn't mean we're going to start doing rate cuts in December. They're going to still go 50 in December, but it means the evolution from 75 basis points to cutting rates has begun. And that evolution is going to happen over several months. And over that evolution, I believe stocks will do well.
All right. Well, great insights for our listeners and HGI investors. As always, Luke, any last words before we wrap today?
Last words. Happy Thanksgiving, right? That's
happy Thanksgiving.
Aaron, I got a question for you.
Yeah.
Do you like turkey?
I love turkey.
Oh my God. Are you serious?
I do.
You you genuinely enjoy eating turkey meat.
You know what? All right, let me amend that. I love a good turkey leg.
Okay.
Like the ones you can get at Epcot
Disneyland
or Renaissance Fair.
Like a Disneyland.
Yeah, turkey. Those things are amazing.
Okay, all right.
Traditionally we fry turkeys, so fried turkey is the way to go.
Gotcha. I can respect that. See, so my wife and I have this thing where we always did Thanksgiving together, obviously, and we always had turkey.
I hope so.
Yes, I hope so too. And we always had turkey. And neither of us were public about our distaste for turkey, but we very privately disliked turkey. And then finally one year I was like, you know what, honey, I just don't like turkey. Like, turkey's just not that good. Like, it's to me, I love my meats. I love all different types of meats, but turkey to me just never cuts it. It's supposed to be really healthy for you. Maybe that's why I don't like it.
That's why we fry it.
Fortunately, my wife was like, you know what? I don't like turkey either. And so, one thing led to the next, and now turkey is definitely still part of our Thanksgiving meals, but we have a lot of the side dishes, and we put an emphasis on the side dishes, and we have some alternative mains in there as well. So I always ask people, I was interested.
Turkey, you know what I'm not a fan of though?
What?
You know what I'm not a fan of? Christmas ham.
See, I like Christmas ham. I can do a good Christmas ham.
Yeah, see, that doesn't work for me.
See, what we do though is
I like ham. I just like the way that like Christmas ham. Nah, it's not me.
Yeah, see, I like Christmas ham. We do Christmas tamales.
Okay.
Mexican runs in the family, so we have tamales. Right. We got tamales on Christmas. That's our thing. But in any event, I'm sure the viewers are tired of us talking about our Thanksgiving dinners. My parting words are: Happy Thanksgiving to everybody. At the end of the day, stocks go up and down. They go up over time, so have faith in that. But life is not work. Work is not life. Money is not life. Life is not money. And family is very important, the most important. Enjoying time with family is the most important. Time is the most valuable asset we all own. So please enjoy. It's been a rough year for stocks. I think they're turning a corner. Reasons to be optimistic. But even if there weren't, there's still reasons to be happy with your family and enjoy this Thanksgiving. So please do that, everybody. I'm going to be doing that. If you like turkey, enjoy turkey. If you don't be afraid to say you don't. I'm a non-turkey fan, so that's okay too. But in any event, thank you guys for listening and have a great Thanksgiving. Those are my final words.
Absolutely. And thank you everybody for listening. Please, if you have any questions or comments for Luke, leave them in the comments section. We love to hear your feedback on any topics you'd like us to cover and always see if we can answer any of your burning questions. Please don't forget to like and subscribe. Have a happy Thanksgiving and holiday weekend, and we will see you all next week. Until then, bye all.